This is not a market correction. This is a structural fracture happening in plain sight. Markets are now open. We track every asset class, every movement dot, so there are no surprises. Today we go through silver, gold, oil, and a war that is rewriting energy markets in real time. We do not look at headlines, we look at the architecture of the system. We have been watching the tokens that trade while CME sleeps, and I will tell you exactly what they are signaling. Now let us get into it, and the numbers do not lie. The mainstream financial anchors are telling you the metals market is experiencing routine seasonal volatility. They're lying or they're willfully blind to the data. Starting with silver. Silver Western spot is at $84. Shanghai was pricing physical at 96. A $12 gap between what the paper future market says silver is worth and what buyers in the East are actually paying for real metal. This is not an arbitrage opportunity. This is the sound of a paper market losing control of the physical reality. Comex total inventory hit 349 million ounces as of Thursday, down 2.2 million ounces in a single session. 9 consecutive weeks of net declines. That is not a trend, that is an institutional exodus. The weekly drain came in at 8.4 million ounces, nearly 262 metric tons in 1 week. Simultaneously, LBMA London silver inventory dropped 2.4% in February, now sitting at 870 million ounces. Both major Western vaults losing metal at the same time. The paper market says 84, Shanghai says 96. The vaults say draining. 3 signals, 1 direction. That $12 premium is not noise. And if you watched yesterday's video, you already know the sequence that led here. 13, 1.5, 13, 8, 13.7, 14.6.1 direction every session. The paper veil does not hold when the warehouse receipts are emptying. You can spoof the price, you cannot spoof the physical drain. That is mechanics, not sentiment. Zoom out for a moment. Look at the tape on gold and understand the silence of the weekend. Gold Western spot is at $5,171. PAXG on weekend markets was at 5,177, essentially flat from Friday's close. Kinesis silver at 85.4, almost exactly where Western paper closed. So heading into last night's open, weekend pricing signals were not indicating a major move in either direction for metals. Do not read that as all clear. Read it as the market has not yet fully processed what happened this weekend, because what happened is not small. The energy market is being rewritten through force. US and Israeli military struck major oil infrastructure in Iran. Oil spilled from depots into streets, entered drainage systems, caught fire. Walls of flame on Tehran's highways. Residents woke Sunday to a skyline shrouded in black smoke and acid rain clouds. Iraq's oil production has collapsed by roughly 60% as the conflict blocks tanker movement. And on Hyperliquid, the decentralized futures platform that doesn't close when CME does, USOIL was trading at $115 over the weekend, after reaching a high of 126. Brent at 97 on the same platform. The mainstream media calls this a regional skirmish. The informed minority knows it is an outright assault on global energy architecture. The oil infrastructure is not the only target. Reports indicate the US and Israel are planning to send special military into Iran to seize its nuclear stockpile, roughly 450 kilograms of highly enriched uranium, enough material for approximately 10 nuclear weapons. If that operation moves forward, a ground incursion into Iranian territory is no longer a contingency. It is a stated objective that changes the duration calculus entirely. Now let me be precise about what the hyperliquid prices mean. Directional signals, not guarantees. The supply disruption is real. The war is real. None of that meant you press buttons the second the CME opened last night. Markets have a way of punishing the obvious trade. And right now, nothing is more obvious than oil going up. If you acted at the open, that was entirely on you. This is financial warfare education, not a signal service. Weekend crude told the real story. USOIL on hyperliquid was up 5 to 6% heading into Monday after hitting a high of 10% earlier. Brent up 6%. Mainstream headlines are pushing a de-escalation narrative. Energy markets are not buying it. They are pricing supply risk, not peace. The Strait of Hormuz remains the central pressure point. Roughly 20% of global oil flows through that single passage. Then Iran struck a desalination plant in Bahrain. That detail matters beyond the headline. Kuwait draws 90% of its water from desalination. Qatar near 100%, UAE and Saudi Arabia both above 70%. When that infrastructure becomes a battlefield target, the escalation calculus changes entirely. Iran's foreign minister warned that attacking infrastructure carries grave consequences. Then proved it by hitting Bahrain's water supply. The conflict has moved past missiles and military bases. It is now infrastructure warfare across the same Gulf coastline directly facing Iran across the Persian Gulf. Once energy systems, water systems, and shipping lanes all become simultaneous targets, the region becomes a systemic risk zone, and oil markets stop pricing supply and demand and start pricing geopolitical survival. Saudi Aramco surged the most since April 2023 on Sunday, and the story underneath that move is bigger than a stock price. Aramco fields came under drone attack this weekend with minor damage at the Bari site and the Ras Tanura refinery, Saudi Arabia's largest, forced to halt operations after last week's strike. The company is now rerouting shipments through Red Sea facilities on Saudi Arabia's west coast to bypass the strait entirely. With 8 supertankers already loaded this month on pace for a record. Aramco also raised its April oil price for Asian buyers by the most since August 2022, and earnings drop on March 10th. South Korea is weighing an oil price cap for the first time since 1997. The last time energy markets looked like this, people called it the 1970s supply shock. Inflation rate policy could not touch dollar credibility under pressure. If you know what gold and silver did in that decade, you already know what this precedent means. There is a strategic dimension worth sitting with. Higher oil prices hit manufacturing economies, particularly China, harder than energy producers. Higher import bills, smaller trade surplus, fewer exports, and oil priced in dollar means every importing nation must first acquire dollars. That is not an accident, it is architecture. Gold becomes critical in this framework. A structurally higher gold price strengthens sovereign balance sheets in an over-leveraged world. Energy, gold, and geopolitics are not separate stories right now. They are the same story. Trump stated publicly the war will continue for a little while, declined to project a timeline, and when pressed, said, "Whatever it takes." 3 words that are not a de-escalation message. That is a war economy message. The U.S. has spent approximately $6 billion in the first week alone, $4 billion on munitions, mostly missile interceptors. That spending rate is a data point about duration, not just intensity. Iran has selected a new supreme leader and will announce the name soon. Israel immediately stated it will target every new leader Iran appoints. Iran declared it is prepared for full-scale war. These are not statements that de-escalate. These are statements of entrenchment. China stepped into the frame with formal language. Foreign Minister Wang Yi, speaking at the National People's Congress session, said China stands ready to restore order, tranquility and peace to the Middle East. This is Beijing signaling strategic interest in the region as future architecture. At the exact moment, the existing architecture is under maximum stress. Iran is a key node in China's Belt and Road infrastructure. Middle Eastern oil flows primarily east. China's posture here is calculated positioning. Now the risk asset picture, because it connects directly to where capital is moving. Over 190 billion wiped from the crypto market in 3 days alone. Bitcoin down over 8%, Ethereum nearly 10%. and that is on top of Friday. The S&P, NASDAQ, Dow and DAX all closed lower. 900 billion wiped from U.S. equities in a single session. Risk assets are pricing a prolonged conflict across the board. But the real road is hidden in the credit markets. This is a structural failure you need to track. Now, private credit. BlackRock just limited withdrawals from its $26 billion HPS corporate lending fund after receiving $1.2 billion yuan withdrawal requests in a single quarter. I'm looking at that really closely. They capped redemptions at 5% and blocked the rest. Blackstone's $82 billion fund hit record withdrawal requests the same week and had to inject $400 million of its own capital to cover exits. At Blue Owl, investors pulled 15.4% out of one fund in January, forcing the firm to sell $1.4 billion in loans just to fund the payouts and permanently halt traditional redemptions at that fund. 3 of the largest alternative asset managers, same window, all hitting the wall. Howard Marks wrote in Mastering the Market Cycle that cycles turn at the point of maximum complacency when the risks feel most remote. Nobody was pricing illiquidity as a problem 18 months ago. Now 3 funds are blocking exits in the same week. The cycle does not announce itself, but it just starts closing doors. Now gold, because the mainstream is not framing this correctly. GLD just recorded one of the largest weekly outflows in recent years. Dollar oil, 4.2 billion left in 1 week at near all-time high prices. Someone is selling the paper. The physical price is not following. Gold is still above $5,170 with that volume of selling hitting the tape. Look at what the paper sellers are doing, and look at how the physical market was laughing at them. When paper seller cannot move the price down despite record selling pressure, the structure underneath is anchored, not fragile. That divergence is the signal. Now the honest case for caution, because balance is what separates analysis from promotion. Paper markets still dominate short-term price discovery. A ceasefire rumor, a DXY spike, or coordinated algorithmic selling can flush silver fast. Physical tightness means nothing to an algo running a stop hunt. 115 on hyperliquid was a weekend signal, not a Monday guarantee. And the data calendar this week is loaded. CPI Wednesday, GDP, PCE, and JOLTS all hitting Friday. Any one of those prints land in wrong hands paper seller exactly the window they need. Respect that short-term volatility is real and it does not care about your thesis. This is financial warfare education, not investment advice. But here is what the complete picture shows heading into this week's trading. 9 consecutive weeks of Comex vault drain. LBMA silver down 2.4% in February. Silver closed last Friday at 84.6, rejecting 85 3 times, despite the dollar being down. That rejection is worth watching. Gold closed at 5170. Gold was the stronger of the two in this move, and that relative strength matters. Watch Comex silver inventory through the week. Watch CPI Wednesday. Inflation data dropping into an active oil supply shock is a particularly interesting read. Verify everything. Comex reports are updated daily, publicly available. LBMA statistics published monthly. The BlackRock filing is on Reuters March 6th. The ones who check primary sources don't need to take my word for any of it. One question to sit with as we navigate Monday. PAXG and Kinesis Silver were flat from Friday's close, while oil hit 115 and Tehran is covered in black smoke. What does the metals market know that we don't yet? Or what is it about to learn? Invest with logic, not hype.